The US has the second largest auto market in the world, yet electric vehicles still make up less than 10% of the market. So if you're interested in gaining exposure to the EV market with sales that are bound to spike sooner or later, Rivian may be the investment you're looking for. But the question we need to ask ourselves is whether or not this is a value investment in the making. Stick around to find out as we talk about that and more in today's episode. How's it going? Welcome to Everything Investing. I hope you're having a great day. Today we're going to analyze Rivian's business and earnings results. We'll start with the full analysis of the financials, the top line, the bottom line, the surprisingly good balance sheet that they have, the cash flows, and finally we'll conclude with an evaluation of this business using our intrinsic value calculator as seen on screen, which will identify whether Rivian is a value investment or not. And if you enjoy the analysis and the value investing perspective, please like and consider subscribing for more of this content. As always, we will be analyzing this business in 5 minutes, so let's jump into it. All right, so here we have Rivian, an American EV automaker. What are they focused on? And as you can see here, their core focus remains on ramping up production. We'll get into the numbers in just a second, but it looks like they're having some challenges with their supply chains and they're expecting those supply chain issues to continue in the future. But they say they're currently on target to reach about 25,000 total units by the end of the year. And additionally, they do have some projects that they're looking to produce for the end of 2025. All right, so let's look at the key highlights that they posted about. They have about 98,000 pre-orders. That doesn't mean that this revenue is recognized yet. It's just pre-orders so far for their vehicles. They have a partnership with Amazon. We'll get into that in just a second. But right now, what we can see here is that they've only produced about 8,000 vehicles up to this point. So that means they say that they're on track to produce another 17,000 vehicles by the end of the year to get to that 25,000 number here. But what did they say about this quarter specifically? And that's that they made important progress. They continue to ramp up production for their vehicles. They produced about 4,000 just this quarter alone. In the first quarter of 2022, they only produced about 2.5 thousand units. So that's good. Their production is increasing there. And they're also expecting momentum to increase here for their pre-orders. They also have a new battery that's coming into production here, and this is apparently going to alleviate some cost pressures that they currently have, and it's going to assist with their long-term gross margins, optimizing costs, and ultimately it's going to drive them towards profitability. Now onto their partnership with Amazon here. As you can see, Amazon has rolled out some of these EVs to some of their American locations here, and this is a partnership that is going to be important for Amazon's commitment to reach net zero carbon emissions by 2040. All right, so we can anticipate this is going to be a long-term partnership, and that's why there's some hype around this stock. Now let's jump into the consolidated statement of operations here. They don't have much data for us to compare to 2021, but we'll still look at the numbers for what they did this quarter and over the past 6 months of 2022. Starting with our revenues here, for this quarter we came in with about $364 million, but they did have about $1 billion worth of costs on that revenues. That leads us to gross profit of negative $700 million. Then we have to deduct for our research, SG&A, etc. We're left with loss from operations of $1.7 billion, deduct for our taxes, etc. And we're left with net loss here of, that $1.7 billion figure. Now, what's going on with their earnings per share figures? They did give us a 2021 figure here. For a year ago, they had about $5.74 loss. This year, it's $1.89. Now, that looks good on paper, but what you also have to understand here is what happened here with the shares. As you can see, last year, they only had about 100 million shares. Now they have 900 million shares. So what that's ultimately going to do is make this earnings per share figure look a lot better than what it is, because there's more shares out there that you have to divide the earnings by. But this is to be expected from a business that is struggling with profitability. They need the extra cash, and diluting the shareholders is a consequence of that. And just to provide some more insight here on the cost pressures that they have, they're saying that they're producing vehicles at low volumes on production lines designed for higher volumes, and it's ultimately causing more cost pressures than they'd like, but they are expecting to improve on a per vehicle basis as production ramps up in the future here. Additionally, they did have costs of materials that were impacted by inflationary pressures, which also drove costs higher. So anyways, so now that we have more insight on why exactly expenses and such have increased so heavily, let's jump into the balance sheet here. And let's start here with the $15 billion that they have there in cash. And if we come down here and we compare this to the debt figure here, they have about $1.2 billion in long-term debt. So this cash figure massively outweighs the debt figure. So that's actually very impressive for this business. They do have a decent amount of cash. And actually, if we compare this number to their market cap of about $30 billion, that makes this investment a lot more attractive, since you'd really be buying the business at about a valuation of $15 billion rather than the current market cap, which is $32 billion. Now let's jump into the statement of cash flows here. For the 6 months of 2022, we can see we have about $3.3 billion in net loss. add back in depreciation, amortization, stock-based compensation, and then we're left with an operating free cash outflow here of $2.2 billion, deduct for our capex, and we're left with a free cash outflow of about $3 billion. They can't do much with that. So before we jump into our calculator here, we don't have any figures here that can help us with our calculation. It's all speculation at this point. So let's try to compare it to some of the competitors in this space. So let's look at Ford here. They're making about, let's say analysts are expecting about $2 in earnings per share for the next few years. Or if we compare this to a company like Tesla as well, I mean, they have transitioned to profitability here and they are doing a lot better and they expected to do a lot better in the future. So if we try to pick a number here, assuming Rivian can reduce their costs and their expenses, and let's say they can start to produce about $2 in earnings per share in the next few years here with a 10% required return. Let's say they can start to grow at 15% per year on great demand and then 20% for the 5 to 10 years after that. On a 20 PE, the stock will be worth about $70 per share. Now, if they can really grow, and assuming we do see a spike in EV sales going forward, let's assume they can grow at 25% for the first 5 years. After that, we'll normalize at about 15%. On a 25 PE, the stock would be worth $113. The current stock price is $38 per share. So with this, we'd be seeing some nice stock appreciation here. But in the worst case scenario, they struggle with profitability. This thing doesn't grow for the next 10 years. On a 15 PE, we'd be worth about $12 per share. Now, if they can pull off numbers like Tesla, and let's just give them $5 in earnings per share, these numbers are going to balloon. And as you can see, yeah, we definitely see a nice bit of stock appreciation, but that again is all speculation. But with Rivian, they're going through a few issues right now, especially with their supply chain. They're not able to produce vehicles at a rate that their manufacturing facilities would ideally allow them. So they're not able to recognize revenue that they should be able to. Another risk I do have here for Rivian is that they do face a lot of competition in this space. Almost every automotive company in this space is shifting to EVs. They're all producing EVs. So who's to say the battery that Rivian is producing is going to be better than the battery that, Ford might produce, or even, potentially we have Apple potentially coming into this space as well. I mean, there's a lot of different factors here that we have to consider, but definitely if we are able to ramp up production here for Rivian, we should see some nice stock appreciation. So it is one of those ones where you have to do your own due diligence here. I am staying hands off for right now. I do like the balance sheet here. I think that makes this a lot cheaper here on this $35 billion market cap here, considering they have $15 billion in cash. So that would make it worth about $20 billion right now. But there's just some underlying issues here I'd like them to take care of first before I think about taking a position here with Rivian. That is the analysis for Rivian Automotive. If you enjoyed the value investing perspective, please leave a like and hit that subscribe. And with that, I'll catch you on the next one.